put it. Here, as Penny and Roy discussed in yesterday's podcast, they had a phenomenal discussion about how window dressing works. It was a definite like classroom moment, teaching the mechanics of window dressing and what the fund managers do and why they do it and how they do it and all this. It was freaking great. So super recommend that. You guys want to learn stuff, listen to these guys talk sometimes, because they get into a lot of very cool discussions. But this was a great discussion. I was paying attention. I was like, wow. Because a lot of the discussion, I'm like, I listen to it, like half listen to it while I'm working sometimes, but then sometimes they get to things that are deep, and I rewind it, and I'm like, oh, I missed that. What were they talking about? And this was one of them. I was like, holy shit, what a phenomenal discussion about end of quarter stuff. Which, Maddie, frankly, if you cut that out, that's a good thing to save, because we can maybe turn that into a video or do something about it. But it was great. So anyway, that's the podcast. And by the way, there's a podcast channel. I don't know why I have to put it up every night when all you guys got to do is subscribe to it. It says right there, subscribe. It doesn't cost anything. So we have the podcast, and then at the bottom is the video. And the members know this. This is our well, it's only part of it because it doesn't fit. But it's one part of our wrap up, and in this case sometimes I pick different parts, but this is the commuter report. This is what we put up after the close, and it wraps up the day very nicely. So you have that. You have a transcript of the podcast, which is totally different than the commuter report. And there's Roy and Penny chatting away. Obviously, you can listen to the podcast here. And then there is the video for the day is down there. And today it was in Legos, so that's kind of fun. Or maybe it's just a picture was in Lego. I think just a picture was in Lego. And I wonder how you go to our podcast and subscribe, share more info. I don't know how you get to the actual podcast. Subscribe. Show subscribe options. That's all the different news feeds we're on. It's kind of cool. I don't know. Somewhere there's a way to like share more info. View the website. What happens if you do that? No, then it just goes to PhilStockWorld. See, there's a flaw in this thing. Is like, how do you go to the podcast website? Because we have a podcast website. Anyway, if you subscribe, though, it'll give you the thing the way you subscribe to it. But there's not a thing that goes to the main podcasting site. That's interesting. I thought it would be there. Silly me. But you can always hit, well, PhilStockWorld podcast. That's easy enough, right? And that's not it. There it is. PhilStockWorld Investing Podcast. That's our homepage for the podcast. So funny. Anyway, so you can subscribe right there too, and you get all the latest stuff and anything we feature and all that. And there's many it's like 150 episodes already. So and we've been doing it every day for more than 6 months. So anyway, that's one way to stay in touch. And the idea is for the podcast, ideally, is that we will why does it say E1? Oh, I see. We pinned that. It was E1. 173. That's how many there were. 173 of them. And the idea is for people who commute. It's a really great way to just sit there, and after you're done with your work and when you're on your way home, you just listen and catch up on the day and find out what happened. For those of you who actually work, that's always fun. So where were we? The markets. Okay, everything's in good shape, so there's nothing to worry about there. All right, good. Now, did this webinar have a title? Were we supposed to be doing something? Oh, you wouldn't know from that page. And you wouldn't know from that page. Oh, nope, we're just talking about the war and stuff. Good. Okay, that fits in exactly with what I want to talk about today, which is just random shit. All right. So we had a nice squeeze. We have this from last week. Login, login, login. Really? Really? Login is expired. Boy, you don't log in for a weekend. They get all pissy. S&P October 25th, November 24th, February, December. Ooh, December. Oh no, that's gold. Okay, so it must be this one. Yep. So here we're above 66 is critical. That's our strong retrace line. So we have made effectively a strong bounce. It doesn't matter where it's from. I mean, we made it we moved up 2 sectors, so we're into a strong bounce off where we fell to. Got to use your imagination a little bit. and it's not quite a half recovery, but the key, as you can see, this is what charts are good for. The key resistance is going to be the 200-day moving average, which is starting to curve over. The 50-day moving average is coming straight down hard. This rally is see how the rally's turning it? Because if the rally wasn't turning it up a little bit more, it's slowing the descent is what it's doing. If the rally wasn't slowing the descent, then the 50-day moving average would be down here in a couple of weeks at 6,700, and then we're going to have a huge problem recovering. And of course, obviously, if it does go below the 200, it's a death cross, also a disaster. Now, RSI, relative strength indicator, when it gets to 30, you're overbought. So we were overbought, and there was the end of the month, and they made this announcement. So we quickly went from overbought to the middle of the range. 70 is 70 is overbought, 30 is oversold. So we quickly went to neutral. And that's not bad, because neutral is almost a 50% recovery. So we can accept that, because obviously if we get back to 100%, we'll be back to being overbought, which, you have to admit we would be with the war, especially if the war is still going on. But that's something you want to take a look at. How quickly do you get from oversold to overbought? And in this case, we went from oversold to neutral with a 200-point improvement. So this range on RSI is 400 points, which means that I can tell you with a pretty good degree of confidence that if we bottomed out here at 62, then we're probably not going to go more than 60. Oh, wait, that's too many. No, it's 400 points. That's why. So that's 400 points. So we're going to have 800. Well, then you can say with pretty amount of confidence, this is 400 points here. Another 400 points will bring us back to 7,000, and we're going to be extended again. So now you have an idea of where the range is going to be, and the range is going to be the same range we had, except on a more extended time frame. So if we can zoom out on this, oh, stop it. What? Okay. So if we zoom out on this thing, and our range is 62 to 7,000. That's our official range now. So here, That range is the range that we failed to get over at the end of, when Trump first came in, at the end of when he got elected and here we failed to get over 6,200. Then we had a big dip when he put his tariffs on, right? And that was like 30% off. So we had a huge dip when he put the tariffs on. We recovered back to 62. And then once we broke above it, everything was hunky-dory for a while. But our range is 62 to 7. That's the official range that we're basically trading in. And the 200-day moving average, which is here it's the 40-week moving average, but a week has 5 trading days, so 200 days. So the 200-day moving average is at 666. Oh, how convenient. So we're at 666 is the middle of our range, and that's where we're going to be going. I mean, that's what the year is going to look like, unless something special happens to the upside or the downside. The war gets worse, the war gets better, whatever. It's not likely we're going to move out of that range. But that means if we find stocks that are well out of their range, so now we're going to talk about what did we just pick up? We just added ConAgra. Because it sold off far enough that we said, that's kind of attractive. That's not terrible. It went from 20 to 15. It went off. It's down 25%. But look at its range compared to its 200-day moving average. So it's well below its trading range. And we did an analysis and we decided it wasn't so bad. And we'll get to that now. Take a look at what Bodhi said. You can always go back to the others. It's pretty far down here. Here it is. So I mentioned it earlier, and Bodhi's saying it's a classic people still have to eat name. They are Bird's Eye, Marie Callender's Healthy Choice, Duncan Hines, Slim Jim. Now, I got to tell you, I was looking at frozen food in Whole Foods, which is not the same, not these brands, but they have other stuff. They have Rao's, Italian, and stuff like that. But I was looking in Whole Foods because when I was shopping in Whole Foods last weekend, I was like, Jesus Christ, things have gotten expensive. I mean, I was really I had some sticker shock about like how much some foods were costing now, and I guess part of it's the war and whatever, but for whatever reason. So as I was browsing around, when I got to the frozen food section, which I never even look at usually, I went to myself, I'm like, so if I buy this pre-made meal, it costs, 30%, 40% less than if I make it. Because they make it in bulk and they do all the stuff and it's easier and whatever. The only problem for me is I can't have all that sodium, so I have to stay away from those things. But it is, and fruit too. That was one that got me. Whole Foods fruit. I think it's a pint. No, a pint's little, right? A pint. Yeah, it was a pint. A pint was like $8 for a pint of fruit. I mean, a pint, a quart, from Chinese food, the size. So from Chinese food, everybody in the East Coast knows their sizes by Chinese food. So a quart of fruit, because I make fruit shakes for myself, was like $15 and something like that. It never used to be that much. I couldn't tell you exactly, but I in my mind, it was more like 5 and 10, not 8 and 15. And that was kind of crazy. So that caused me to look in the frozen fruit aisle for the big bags of frozen fruit that they have, that are made for putting into shakes. And those are considerably cheaper. Like frozen fruit is, and same for frozen vegetables. Frozen fruit and frozen vegetables are way cheaper than if you do it yourself. So, and then I know you guys are probably saying, what, how could he not know that? It just, I never really bothered looking and seeing how much cheaper it was to buy it that way. So therefore, obviously, this is good for Conagra because they make a lot of this frozen fruit. They buy in massive, massive bulk and they package it up and they chop everything up for you and put it in a wrapper and you put it in your microwave and there you go. So it's a good business. It's a good trade down business for the consumers. And I think once people start doing it, the convenience aspect will stick for a while. So their problem right now is, of course, though, their raw material costs are pushing their margins because the cost of the meat that they put in the things and the vegetables and the fruit is also going up for them, but not as badly as it is for us. And that will still lead to more business. And also, as those things get more expensive, then people are willing to pay, instead of $5 for the TV dinner, they'll pay $7 for the TV dinner, and it still seems a lot cheaper. Like I bought a bag of fruit that was $13, but it was 3 pounds. It was like, I'd have to say at least 3, maybe 4 quarts of fruit. So I paid three, like instead of paying per quart, let's say it's 3, instead of paying per quart $15, I paid $4. So that's a pretty big freaking difference. So people trade down, and that's a big theme of what's happening now is consumers are trading down and trying to cut costs in different ways. So when you see companies like this, you say, oh, that's kind of good. Their balance sheet, they're fine. They're just a big, they have a big balance sheet. They have $8 billion in debt. They have $8 billion in debt because they got to constantly roll inventory and do all this stuff. It's just normal for a company like this. It's not a red flag. It can become a red flag if rates go flying up or something, but given the situation where we are. So, as Bodhi said, it's not a home run growth story. It's a shelter story. It's a safe stock, and we don't need it to go up. We just have to sell margin against it and collect premiums. So the play we came up with one for the $700 a month portfolio. And in that portfolio, we're buying $15, $13 calls for $360. We're selling $10, $17 calls for $190. $360 minus $190 is $170, right? So we're paying net $170 for a $4 spread. Well, right there, that's good upside. But what we're doing is we're selling 10 less calls, 10 less short calls. That enables us without margin. We can't sell puts. So that enables us without margin to sell 5 short-term calls for 70 cents, the 16 calls, which are out of the money. And that's $350. So the net is $31.50, this minus that. And that's $31.50 on a $6,000 spread. We get almost 100% upside from the spread, plus $2,100 in potential short-term call sales. And first of all, they're covered, right? The 13 calls are covering the 16 calls. Second of all, clearly, these are 70 cents. These are $1.90. We will easily be able to roll these to the higher calls, even possibly to $20 calls down the road. And if we do that, then we've widened the spread on one third of our longs. We'll have a wider spread. And we would only do that if it was necessary. If Conagra went up faster than we thought and we go underwater on the short calls, it can't stop us from collecting our $4. There's nothing that can happen that's going to stop us from having a 1370 2028 spread. We can always roll we can always roll 70 cents to 190. So that's why there's no danger in that kind of selling. We could even roll them hopefully to 20 or whatever if necessary, if it keeps going up. And so that's our worst upside case is we collect all this money. And all that money is, how much is that? 90 and then plus 66. So 156% upside potential in 2 years, just following this very, very simple little trade. Nothing wrong with that. That's how you make money. So we love this for the 700 a month portfolio. And no margin required. Then the LTP, we have margins, so we're doing something different. Here we're going to sell the $17 puts. Don't forget the stock is only 15 something something. What's that price say? What? 1560. Yeah, okay. So the stock's at 1560. We're selling the $17 puts. But that's because we think ConAgra is very underpriced. We're very comfortable with our $17 target. And what are we doing? If we sell the $17 puts for $370, then we're paying 17 minus 3.7 is $13.30. So it's not about, ooh, we sold the $17 puts and they're already in the money, blah, blah, blah. It's no, we agreed to buy ConAgra for net $13.30 with the stock at $15.60. That's $2.60 off. That's still 15% off the current price. But if we're right and ConAgra goes up, instead of selling the $15 puts for $2, let's say, we're collecting much more money. We're making a huge amount of money on the upside. So we've increased our upside potential significantly without really increasing our risk. In fact, let's take a look at that. And I certainly don't recommend doing this for everything, but like I said, I think ConAgra is a fairly safe stock. I think we're going to be, it's highly unlikely it goes down very far. And what were our choices? Our choices were selling the 17 puts for 360 or whatever I said. The 15s were 230, 240. So let's say 240. And what would the net be if we sell the 15s for 240? So 1330, right? But if we sell the 15s minus 240, it's 1260. It's only a 70-cent difference. We're only getting the stock 70 cents cheaper if it goes to 15. But like I said, our upside goes from 250 to 260. It's $1.10. So we have $1.10 potential more upside by risking paying 70 cents more to the downside. If we got assigned, if we probably won't. So that's why that decision got made. The spread is basically the same as the, see the 13, 17, 16, 13, 17, 16. It's basically the same spread. Those are still the best strikes in a combination to sell. We're being a little more aggressive. Here we have nothing uncovered. Here we have 50, 40, 20. That means there's 10 uncovered short calls. But, well, there's a couple of things. First of all, if we get burned on the short calls, if ConAgra suddenly goes up, in the long-term portfolio, we can easily buy more 13 calls and cover it. Even if these things went to $3, right? And these 13 calls went to $6, we could still buy these for $6 and then roll these up to the 20s, and we'd have like a $7 spread for less, it'd still be less than $6. Well, it's 6 minus the 70, so it'd be $5. So in other words, if this thing blasted higher, we could always cover it by buying some more long calls, and not too many, frankly, anyway. We only spent we have a $275 credit. We spent 0 cash out of pocket on the spread so far. So if for some reason we had to buy 10 more of these and they were $6, then our net would be $6,000 on a $20,000 spread. We'd still be good for 200% gain. And so that's my logic there. So we can afford to sell to oversell a bit because we've got flexibility. Also, we could pay to roll them up. We could buy them back. There's so much stuff that we can do. Then we sell 15 puts. Now, and again, here's the thing. If we get burned to the upside, then this $1.25 drops into our pocket, $18.75, and we could then use that money to roll these to a higher strike. So we could roll ourselves out of trouble. This 1875 divided by 20 is what? 90 cents. We have 90 cents per contract. So we could be down 100% and the puts will pay for it. We have 90 cents per contract to pay, to adjust, to roll, to buy half of them back, whatever. It is impossible. It is a mathematical law of the universe impossibility for both of these to be in the money in June. You're either going to be above 16, in which case the puts expire worthless, or you're going to be below 16, in which case the calls expire worthless, and we're simply going to roll the losing side. Now, if we're lucky, it'll expire at 16 and we make money on both sides, but probably not. But anyway, we spent zero money for this thing. We're selling $3,000 in premium. And obviously it's not 3,000 because it's at 1560. So technically these puts are 40 cents in the money. So if you want to be technical about it, it's 195 minus 40. It's 155 in total premium that we're selling, not 195, but doesn't matter. And so one of the sides is going to expire worthless, at least, and we keep the other side. Then we're going to roll the losing side, the side that we lost on. It's still an active an option at the time. We will then roll it to September, 3 more months, July, August, September, right? We're going to roll it to September, and we will then get paid there. So let's say, well, it is now February, March, April, May. So I'm sorry, it's not February. What am I talking about? It's April. It's April. And so June is the next cycle. So if we had sold the $16 puts and calls in April, see them right there? They are now worth, well, they shouldn't both be worth money, but we're not at expiration yet. But at 1565, the puts would still be worth 40 cents, and the calls would expire worthless. And then what would we do? We would roll the 40-cent puts to the June, let's say the June 15 puts, which are 80 cents or 75 cents. So we would collect 35 more cents on that side. And then at 1560, let's say we sell the $16 calls for, well, let's call it 65. So we sell these for 65. So we'd pick up another $1. And if we sell 25 contracts again, no, it's not 25 contracts. Sorry, it's 35 contracts. We would get $3,500 of additional income in June, minus the $600 we would pay to cancel the short April calls, the short April put. Sorry. So is that clear? In other words, 15. If we did it that way and we ended April at that strike, we roll to the next quarter. But what are we rolling? We're rolling just the loss. The losing side would get rolled. In this case, the losing side would be 40 cents times 15 contracts is $600. So we have to pay $600, but we would roll to 3,000 or whatever in premium in June. So we're putting more money back in our pocket, and we're widening the spread at the same time. And if we widen the spread by $1 every quarter, then at the end of the year, we're going to have a $2 wide spread. That's why we can afford to start with a tight spread, because we know we're going to just roll it and roll it and roll it. And if we add $1 each time, and $1, by the way, is like 6% of the trade of the strike price. But if we roll it $1 each time, at the end of the year, we're going to have a $2 spread. At the end of 2028, if we keep rolling them wider and wider and wider, we're going to have a $6 spread, which is a huge amount, 1/3 or more than 1/3 of the cost of the stock. That's how wide we can roll this, just by simply rolling and collecting and rolling and collecting and rolling and collecting. So that's the system. You have to have faith in the system. And that, again, it goes back to the whole casino model, right? Because the casino has faith that you will eventually lose your money. If you keep playing, you will lose. So what do? You roll and you lose, you roll and you win. But what you don't realize is that when you win, there's a certain percentage the house takes. They don't pay you as much to win as they take from you when you lose. When you lose, they take 100%, right? But when you win, you don't get the full odds. You get a little bit of there's a little bit of a shave every time. But it's funny, even if the shave is only 3%, 3%, 33 times is 100%. So if you roll the dice 33 times, they're going to take all your money. Now, that is if you lose every time, but statistically, not if you lose every time, sorry, if you win every time, they're going to take back a large portion of the money that you've got. When you lose the whole bet. When you win the bet less 3%. Eventually that just erodes away your stack of money. Yeah, that's why you can feel like you were doing good at a table in Las Vegas. You think you were doing good. You're like, I hit a whole bunch of numbers. How did I end up with nothing? What happened? And everybody thinks it's, because right at the end there, I shouldn't have pushed it too far. I did this and that. That's how the game works. They keep you playing until you lose. Then when you have no more money, they say, would you like to buy some more chips? Would you like you want what do they call it? Marker. Yeah, you want a marker? You want to borrow some money from the bank? And you're like, and some people go for that. But the reality is, they know if you keep playing, you're going to lose. And you know what? We know that too. If we keep selling premium, we're going to win because all premium expires worthless. The position might change in strike. Every time. So here we are, and we sell 3 months out, right? So let's say we just sell right on the money. We're at 17. We sell the 17 puts and calls, right? And we sell them for a total of $3. So now we get to 1 month, 2 months, 3 months. And in 3 months, we're right at 17. They both expired worthless. We lucked out. And so we keep the $3 or $2 or whatever it is. Let's say it's $2. So we keep the $2. Now what do we do? Now it's 17. Now, if we have a different opinion, if we think it's going to go higher, then we might want to sell the higher calls. But if we don't have an opinion, we say, okay, we'll sell the 17 puts and calls again because we really have no idea what it's going to do. So now we sell February, March, April. Now we sell the April 17 puts and calls for $2. So here we are. It is April 1st. They're going to expire in a couple of weeks. And the stock is at $15.60. It's $1.50 below 17. But we collected $2. We're fine. We won $2 here. Here we're up 50 cents. It's not a loss. And even if it is a loss, the calls are going to expire worthless. We're only going to have to take the puts and roll them. And so in this case, being ConAgra, being that we think it should be higher than it is, we would probably sell the $16 puts. We'd probably roll the $17 puts to the $16 puts in September. And maybe we'll still, and then we'd see about what calls we sell. But, so in other words, within it, we can make tiny adjustments that make us a little more bullish, a little more bearish on each bet that we make along the way. But overall, we're just selling the middle of the range, basically. And sometimes we'll win the whole thing, and sometimes we'll win some of it. But I'm sorry, that's what I meant. What's going to happen on April, in 3 weeks, what's going to happen in 3 Fridays from now is the premium, the $2 that we sold in premium is going to be worthless. The only thing that's left is the intrinsic value. What's the actual difference in price between $15.50 and 17, which is $1.50? All the premium will be out of it. That's how our system works. premium expires worthless. The position of the stock could change, but the premium expires worthless. And when you can look at a longer term chart and say, well, these guys since last July, have been pretty range bound between 15 and 20. So obviously 17 is the middle of that, 1750 to be exact, but 17 is the middle of that. And that means that if it stays in this range up and down around 20, then we just keep selling in the middle and we're going to make some money. Not every time, but if it's high in the range, we sell more calls. If it's low in the range, we sell more puts. Not complicated, but the goal is to sell premium and sell a certain amount of premium where we're not likely to get in trouble. And like I said, so in this portfolio, can't get in trouble. The construction of this trade, you cannot get in trouble. In this trade, I mean, the trouble you'd have is if ConAgra went way down, but not from selling the margins. In this one, we're taking a little bit more of a risk, but we're collecting so much more money, it's worth it. We're collecting extra 1,000 a quarter. And so 7 quarters of 1,000 a quarter is $7,000. We didn't even spend any money to buy the spread. And that's just our bonus money of 1,000 a quarter. So that's the business we're in. It's costing us no money, a 275 credit, to open this business. And the purpose of this business is to sell $3,000 a quarter in premium. Now, the first quarter is already baked in, so that's June. But in June, when these expire, we have 6 more quarters to sell $3,000 in premium. That's $18,000 more dollars on a spread we paid nothing for. It's like somebody gives you a business and says this business makes $3,000 a quarter. You can have it for nothing. And you say, well, how much work do I have to do on this business? They're like, well, every quarter you have to roll the options. That's your job. Every quarter you got to look at the position, and then you've got to take the calls that you sold and the puts that you sold, and you've got to roll them to the next quarter. It'll take about 5 minutes. And we'll pay you $3,000 a quarter for that job. That's what this is. It's amazing that more people don't do it. But it's not amazing because, frankly, think about how you learned this, or if you're still learning it, as we also discussed today in chat. Think about like how it's counterintuitive. So it's very hard for people to get their brains around it. It's not what you would ordinarily think of. You're not playing to win. You're playing to be in the middle. In fact, you go back to Vegas. I had a crap system, and to say it's not, and see, it's funny because there's no such thing as a crap system, because again, they're going to take your money eventually. But my system wasn't designed to make money, and that's why it worked. My crap system was designed to put a lot of money on the table in play, but not to really lose or win much money. And what did I do? I don't want to bore anybody who doesn't know craps, but here, I don't want to make a big thing of this, but whoops. And my crap system was based on the same concept as options. Really, it's a hello. Why is that not? Oh. That seems simple enough. All right, try that one. Here you go, Wikipedia. So these are the bets you can make on craps. So annoying. Okay, so I'm simplifying this just for speed. The way craps works is you put money on a pass line when the roller starts. You don't even have to do this part, but when the roller starts, they throw the dice and they establish a point. If it's 7 or 11, you win automatically and you double your money and they just go again. If it's 2 or 12, 2, 3 or 12, 2, 3 or 12, it's craps, and then you lose your money instantly. So 7-11, which are much more likely than 2, 3, 12, will double your money. 2, 3, 12, you lose your money, and that's a fairly fair bet. It's in the 50-50. So I play it because why not? Now you play, and then if they roll any of these numbers, 4, 5, 6, 8, 9, 10, any of those numbers becomes the point if they hit it. Once the point is established, now you have effectively bet on that number. It has to be rolled again before a 7 for you to win. So what do I do? What are the most likely, again, statistics. What are the most likely numbers to be rolled besides 7? 5, 6, and 8. Or 6 and 8, really. It's really 6 and 8 are the most likely numbers to be rolled. So if the point is established, if the point is not established, I just let it play out. If the point is established as 6 or 8, then I go to work. I take the money from the past. I take the money from the point. If my point is 8, I also put money on 6. I put money on 6, and I put money in what they call the field, which is basically every other number. So now my bets are. So now my field. Now my bets are. If I make a 6, I get paid. If I make an 8, I get paid. And if it's any of these numbers, I get paid. So now I bet almost every number on the table. If I win in the field and it's not 6 or 8, then I take that money and put it on 5, and then I put it on 9. Those are the next most likely numbers. At that point, now notice 4 and 10 are field numbers, so you get paid anyway. Now I have a bet on 5, 6, 8, and 9, and the field. That means any number they throw but 7, I'm going to get paid on the next row. Statistically, 7 is going to come up 1 out of 4 times. So I'm either going to be lucky, and they roll more than 4 numbers, and at this point I'm taking the money off the table every time I win. At this point I'm going to get lucky, and they roll 4 numbers, and I make the money, or I'm going to be unlucky, and they're going to take away the money. Now, like I said, this thing is not going to make you any money. Doing it this way, you will barely stay even over a period of time. But the point is not about making money. The point is when they rate you as a player in craps, they rate you based on how much money you have in play at the table on the average per roll, and then they multiply it by how long you play. And so I could end up with 100 here, and 100 here, and 100 here, and 100 here, and 100 here. I could end up with $500 on the table on what they perceive as an average. They're like, hey, this guy is always throwing $100 chips on the table. He's got 3, 4, 5 in play at any given time, right? And over the course of an hour, they're going to roll 60 times. Let's say they roll 30 times in an hour. So if they roll 30 times in an hour, and I've got $500 on the table, that's $15,000 I'm putting in play per hour. That makes me a high roller. And the casino, they don't look at your actual winnings. They just know that if you're playing $15,000, and you are probably statistically going to be losing every hour, you're probably going to be losing about a third of that money. And they figure you're losing about $5,000 an hour. So if I play 3 hours a day of craps, and they mark me down as being a person who's willing to lose $15,000 per day. And you know what that means? That means they give me a suite. It means they give me dinners. They give me show tickets. They give me all this stuff. So what am I doing? I in the course, and now of course I'm going to quit. They don't know that, but I'm going to quit if I lose $1,000. I'm quitting. That's enough for me to lose on a day. So what am I doing? I'm limiting my cash losses to a few $1,000s over the course of a weekend, right? But they are comping me a suite and my shows and my dinners and everything else that they can possibly do for me is being comped by the casino. So I'm getting, in the very least, a free trip. If I happen to have a lucky streak, I get a free trip, plus I make a few $1,000. But I'm not, and I've had times when I lucked out, but I certainly have had times when I lost too. On the whole, it's more of a break-even plan, except for the fact that I get to go to any Caesar's Palace in America for free and stay in a great suite. My motivation for playing is not what they expect. And that's exactly comes back to that's what we're doing here. Our motivation for selling puts and calls and constructing a spread is not to win. That's why this is hard to get your mind around. We're not trying to win. We're trying to make the money along the way. If we win, it's a bonus. But we don't care about winning. We care about the income, because the income we can count on. That's why we say be the house. The house isn't trying to beat you. The house is playing a game where statistically the laws of chance, the laws, the odds, the statistics of the game dictate that if you play a certain amount of time with a certain amount of money on the table, then a certain amount of that money will come into your pocket because the odds are in your favor. Every single time there's a roll, every quarter that the time runs down and the premiums expire worthless, the chances are that you're going to make money on the short calls and short puts that you sell. They wouldn't be available at that price if they weren't profitable for the house. And in this case, the house would be JP Morgan and Goldman Sachs. The great thing about options trading is you get to sell the same exact options they do. You're not the market maker, but you get to sell for the exact same price as a market maker. And that's what's phenomenal about it. But you know what? It's very boring for people who don't pay craps, but it's like being the guy who plays the opposite side of the table in craps. You can do that. You can play the opposite side of the table in craps. You can bet against all the players, but nobody does it because it's upside down. It's profitable. It's a great spot to be, but the problem is that you have to think opposite everything. You're against all the players. You don't want the same things they do. When 7 comes up for them and they're happy, you're sad. When 2 comes up for the table is sad and you're happy, that kind of crap. It's a real big shift in your thought process to get yourself to this side of the table and be the house. But that's why 1 million people a year go through the doors of the Bellagio, and not one of those people is as rich as Steve Wynn, who owns the Bellagio, right? He's a billionaire. He owns that building. You're just walking in and playing the games. He owns those games. He's the house. He makes money every single time somebody plays a game. He's making some money. And yeah, sometimes he pays out a jackpot. Sometimes we lose on our options. That's part of the game. You're going to lose sometimes. You're just not going to lose enough where it's going to probably hurt you. But that depends, of course, on how you construct the game. Because that's why you go to a casino. You see the same freaking games in every casino in the world. Why? They are very carefully constructed machines that are there to make money for the house. And they have been tried over hundreds of years. And it has been decided by all the people who ever owned casinos that blackjack, craps, baccarat, roulette, okay? These are the games that absolutely guarantee the house a steady stream of income. That people think they win, and they do win. Some people win. There's a winner at the table. You've sat at tables where a guy's won big. You may have won big at a table. But you know what? Other people don't win big. The whole table doesn't win big. Or over time, the money goes away. And people are very, very bad at walking away from winners. Again, look at the problems everybody had here when I was trying to get everybody to cash out. I spent 2 weeks explaining why we were going to cash out, and then finally we did it and we cashed out. But I literally had spent 2 weeks explaining why we were doing this because nobody wanted to do it. What about this? What about that? Blah, blah, blah. And of course, now the market's up. We're up another 300 points today on the Dow. We're up 1% basically across the board after being up 3% yesterday. So now we're up 4% in 2 days. It seems like, well, maybe we should have stayed in the market. But you know what? We shouldn't have, because different stocks are going to do well under the new conditions than were doing well before. And now we have an opportunity to jump in and invest in them. Or things like this, where this spread is going to make 7,322%. I don't know how you can argue with that. We didn't have any spreads that were making 7,000% before. Now we got a freaking food company that's making 7,000%. So that was Conagra. The other one we liked was Nike. Nike's down 14%, and their quarter wasn't that bad. You know what's happening. Don't forget freight costs. Here's the thing. If NVIDIA ships a shipping container of chips, there's probably, I'm going to say there's 1,000, probably thousands, but let's say there's 1,000 NVIDIA chips in a shipping container, right? Well, that's 1,000 times $50,000, $50 million worth of chips in the shipping container. So if the cost of the shipping container goes up from $2,000 to $10,000, NVIDIA does not care. Does not affect them one bit. They would not even notice. In fact, the shipping guy should have charged them that much anyway, because they would have paid it before the prices went up. It's not a factor in the equation for them how much shipping container is. On the other hand, Nike is shipping sneakers. So a box of sneakers, let's say, arguably, I don't think it's a cubic foot. Now, it could be a foot. So let's say, well, it's a foot long and it's a half a foot wide and maybe a half a foot more tall. So that's 1 by 6, so 2, 4. So 4 sneakers would be a cubic foot. All right, so let's say that Nike can put 4, and let's say they can put 1,000 sneakers in a container. All right, so for argument's sake, let's say Nike can pack 1,000 sneakers into a container, but their sneakers are only well, that's wholesale. So let's say wholesale they're $100. So now it's $100,000 shipping, $100,000 worth of sneakers in a shipping container. But now the cost of the shipping container has gone from 2 to 10, and so it's 8,000 more. So on $100,000, that difference in price for Nike is $8,000. It's 8%. 8% cost increase on the cost of moving the sneakers from Asia to here. And then plus, of course, they ship it around the country and distribute it too. And then there's fuel costs and so on and so forth. And obviously UPS, FedEx, everybody's increasing their costs. So that's one problem Nike has. It's hurting their margins. Also, tariffs are killing Nike. And it's the same kind of issue. It's the same thing. It's just a huge proportion of their expenses have been bumped up. This will eventually wash out. Eventually, the people who pay $200, let's say a Nike sneaker is $200 retail, it'll eventually be $220, $230, $240, and people are going to go, oh, what can you do? Remember when those were $199? That's what you're going to say. So you're not going to not buy them. You're just going to say, okay, they're freaking $250 now. I mean, you've done that with many things that you buy. You now reconcile yourself to say, oh man, I can't believe how much this is now. And you still buy it. Like cars, $50,000 freaking dollars for a car. And yes, I have my whole life bought expensive cars, but now they're a little ridiculous. Once they hit $100,000, once the car goes over $100,000, I'm like, what am I doing? But even the cheap cars are $50,000. That's what drives me nuts. It's like even the cheap cars are a fortune. My daughter went to buy a car. I said, don't buy don't buy a new car. It's ridiculous. But I mean, what are you gonna do? The used cars are ridiculous too now. Or steak. God, have you guys gone out for a steak lately? I don't mean Texas Longhorn. I mean like like a serious steak. Um, even actually Texas Roadhouse. My brother was just bitching about that because he said you know he goes 3 4 months ago I'd go to the Texas Roadhouse and I'd have a big meal and I'd be full, and he goes now it's almost twice as much money with half as much food. They've been cutting back the food and charging double. So anyway, eventually people will get used to the price of Nikes, and also the price of their competitors will go up. It's affecting everyone. It's not just affecting them. And you'll hit equilibrium, and they will change also. Nike will say, you know what, we don't have to hand stitch this anymore. Little things will start changing. They'll be like, we don't have to do this, or this quality could be lower and we can use less of this material, and so on and so forth, until they shave 20-30 bucks in the cost off their shoes too. And they're still going to charge you more, but they're going to also shave the quality. So you will, as a consumer, and this is what capitalism was all about, you will pay the most possible money for the shittiest possible product. That's capitalism. They will figure out how to charge you as much as possible while giving you as little as possible. Those are the incentives. And that's why luxury brands are falling apart now, because you've got there's types of luxury brands. Calvin Klein is doing well. They're getting a nice pop from that Kennedy thing that's on Netflix. So Calvin Klein, Yves Saint Laurent, things like that, they're doing pretty good. But the super luxury, like the Cartiers and the things like that, where they can't compromise on quality. And because they can't compromise on quality, they have to pay whatever the frick it costs for the teeny tiny gears and the little diamond thing and whatever. All these things cost more and more money, and they can't cut back because their image rests on that. And that goes for like Coach bags and things like that. It's all this stuff where you've cultivated a consumer that is extremely concerned about every little detail of the product you make. And if you stop doing it, they'll go to another luxury brand that hasn't compromised yet. But those are your core demographic. The problem is when you cater to the top 1%, or not even 1%, the 1/10, the 1/100th of 1%, when you're catering to just those few people in the world who can afford your shit. Because these stores, you go to these luxury malls. If they make one sale a day, they're happy. These freaking stores have $3,000 handbags. They only need to sell one. they just sit there all day long in an empty store, and if one person comes in and buys a bag, they're thrilled. I mean, they only sell like 2,500 Ferraris a year. Everybody knows their name. Everybody heard of Ferrari. They make a lot of money, but they only sell 2,500 cars a year. There's a waiting list to get them. They like it that way, and that's smart. But if you're in between the cracks, if you're Coach or Hermes bags or whatever, you need to sell worldwide 1 million bags. You can't sell 1,000 bags. You're not going to make enough money. They're $3,000 bags. $1,000 is $3 million. That's not a company. It's a hobby. You got to sell 1 million bags and make $3 billion. So that's their business. But the problem is, there's 8 billion people, right? So 8 billion people times 0.0. So that's 1%, 10th of a percent, 100th of a percent, right? Oh, I better make one there. So 1/100th of a percent of the population, or I'm sorry, this is 1%. This is 0.1%. That's 1/100th of 1%. So it's 1 in 10,000 people. That's only 800,000 possible customers in the world to buy your freaking bags. Now, as you know, though, there's 8 million people in the top 1/100th. Those people will buy some bags. That's the thing. So those people want some bags. They want the same bags that the top 0.01% make or buy, that these 800,000 people can afford. But you see, these people can afford plenty of bags. They make $10 million plus a year. They don't care how many $3,000 bags they buy. So that's their core customer base. They're going to buy these super duper luxury bags. The people in the next class, they only have they only make $5 million a year, or maybe even less than $5 million a year. They have to think twice about buying $3,000 bags. And if things get tough and their cars go from 50,000 to 60,000 or 100,000 to 120,000, that's, a couple of bags that they can't buy. They have to actually make a choice. The top 800,000 people don't have to make a choice. There's no choice. They've got a net worth of $100 million. They make $10 million plus a year. They're not worried about the price of a bag. They're not even worried about the price of the cars. They're not worried about the prices of the homes practically. None of that is a consideration for them. They're in a different universe of thinking than we are. But so there's Ferraris. These guys are going to buy a Ferrari, whether it's 280,000 or 300,000 or 320,000. They don't care about that. They'll pay extra to have it next week. They'll pay extra to have it dropped off at their house in Europe. That's not that they're not worrying about the price of the Ferrari. The problem is, though, that they're also not going to buy. They're not going to buy 10 bags this year. A woman who might go out every season and buy a new bag, and she's got 20 bags in her closet that are $3,000 each. She's not going to buy 2 bags a month. She's not going to up her spending on bags. So no matter how much they advertise, no matter what they do, no matter what they say, those people are going to be pretty steady buyers. The aspirational people, the 8 million people who can afford the bags, but a special thing like it's going to be, they're only going to have like out of 20 bags, there'll be 4 in the closet at that level that are that nice. Those people will stop buying bags very quickly when money gets tight, because there are more important ways to keep up appearances than having a new bag for the spring, like making your Ferrari payment. It's a different ballgame, right? So that goes back to what we were saying about Nike. So what's the deal with Nike? They're aspirational. They're a model that is generally on the higher end, and it's not a middle class product really. It's an upper middle class product, and obviously there are many street kids, aspirationals that go to Nikes and stuff. But you know what happened? Unfortunately, this is what killed Nike. They did this. They decided to cut out the retailers, and they started going direct to consumer. But what they didn't realize is that the consumer taste had shifted, and Converse was becoming cool again and things like that, and they were missing the mark over and over and over again with their brand, and people couldn't justify paying the extra money for Nike. It just seemed ridiculous, and they didn't have the same caliber of athletes they used to have. They did so many things wrong in the row. It was crazy. But they can fix it, and they can fix all of it, and they've already started fixing it with the celebrities that they have, and they have to find the right mix of products to sell to the audience that they are attracting, and that's going to take time. So anyway, so with Nike, we sold $40 calls. Don't forget, Nike's at 45, so we went low on Nike. I don't have the kind of confidence in Nike that I had in Conagra, but I'm sorry, which ones do we sell? We sold the 45 puts. We're at 45. Aren't we? Yeah, we're at 45. I sold the $45 puts, and those are $8.50. So the net is $36.50. So the net is $36.50. That's another 20% down from where we are now. So that's where I'm putting my foot down. It's not aggressive the way we were with ConAgra. I think Nike could fall 20% more. But if it does fall, and if it falls 20% more, we're only even. We just have to give the $8.50 back. If it falls 40%, then we're out $8.50. But you know what? 40% is $27, half price. So if they fall 47%, if they fall 40% and it's $27, then I will then have these at 36, right? So 36 plus, and I will double down at 27 and divide that by 2, $31.50. $31.50 is 33% off the current price. I will do that. So in selling these 45 puts, I'm basically saying I'll have 3,000 shares at $31.50. If I can commit to that, then I've got no problem with this spread. There's nothing that's going to bother me here. So that's where that is. That's what that number comes from. I'm willing to do that. I'm willing to have 3,000 shares. I'll own $100,000 worth of Nike stock at $31.50. And again, I say that now. If it turns out that the tariffs go up again and the shipping crates go to $25,000 and whatever the hell else bad stuff happens as the war drags on, I may have to rethink that. We may take a loss and get out if all those situations change. But in an empty channel, yeah, that seems like a good spread. So for me, I have no problem with this. I consider the $12,000 I get paid for doing it to be effectively free money that goes in my pocket, because I'm willing to take the assignment and even double down after that. Then we look at like, are we going to make money on this spread? Yes. And since we like the spread and we decided to do it, when I was in the process of it, and I thought the webinar was going on, so I had to quit in the middle. So we sold those puts. We're buying a 50-40, so 10 uncovered, 40-55 spread. Again, we're at 45. It's not terribly aggressive. We're giving it 2 years to go up $10. But again, it's not about the long spread. My Nike strike says if I've collected the 45 puts, I'm basically saying I think Nike will hold 45. If Nike holds 45, the short puts expire worthless. The $40 calls pay $5, which is $25,000, and then these would go worthless. So that's not bad. Then we're selling the June 45. Notice I'm selling the June 45 calls. I don't think Nike's going to go up between now and June. And if it does, we're going to just roll them along. And if we roll them along and this spread is in the money, we're going to be thrilled. But we're not playing them to go higher. I'm saying if they go flat, because you know why? The flatness, 40, and we're calling 45, 47, 50. So the flatness pays us $10,000 a quarter. And we got 6 quarters to sell. That's $60,000. So what do we spend on this spread? So we have $60,000 to collect. The whole spread is $75,000. Oh, I keep doing the same thing. So what are we laying out? Well, we spent $25,600 for the long calls. Oh no, wrong number. It's 1225 times 50, 61,250. I'm sorry. Minus we sold the puts, minus 12750, minus 25,600 for the short 228 calls, and then minus $10,800. Minus $10,800. So our net cash outlay is $12,100, And every quarter we're collecting $10,000. So our net outlay, as soon as we get to June, if we're anywhere near this range in June, then we're going to sell September another $10,000 worth of premium, and our net outlay will drop to $2,000. Oh, that didn't work. So we will have no money in the spread, margin, but no money. But we'll have no money in this spread by September if all goes well. And after that, all the money we collect, which is 5 more chances to sell 10,000, is $50,000. Is just free money that we're collecting by being in the house. Plus, if the spread happens to go in the money, and it's $5 in the money now, but if the spread happens to go in the money, it can pay us up to $75,000. But that's a bonus. The $50,000 is the business we're buying. We're buying a business for $12,000. That's net cash outlay. That produces $10,000 a quarter in income. That's worth it. That's why we like this spread. Was this available before? No, it was not. I've been watching Nike for a long time. I thought Nike was cheap for a long time. Now it got crazy cheap. So all the way down here at 60, it's been on our watch list, and I said if it gets cheaper, I want it. I was thinking 50. I did not think it would get to 45. And especially on a beat. That's a beat. That's a beat. That's a beat. That's a beat. They are constantly performing better than people expect. This is a bit cheap. But Nike is an expensive company. It was trading at 30 times earnings from last year's earnings, trading at 24 times earnings next year. This is not super cheap. So I don't want to overcommit to it, but I think they will grow back into their valuation. They're capable of making this money. That's part of the analysis that we had. All right. Now, do I remember how to find the chat thing? Campaign manager. What the hell is that? Huh, weird. Go away. Is this? Oh, here you go. Now let's see if we have any questions. Brad says he liked the Bloomberg show. Oh no, I can't even see the whole question. I do not like this interface at all. All right, Brad says, that was a very enjoyable Bloomberg show last week. As I learned more about options, I realized there are some disadvantages to being Canadian. Yes, there are. The SQQ hedges are great, but it seems Canada, they're only allowed buying the SQQ and block any selling of those options, deeming them restricted. If you have time, can you touch on an alternate hedging idea? I'm thinking maybe a simple index option, butterfly spread placed behind. Well, to be quick about it, because ask me in chat when we have time. You can do QQQ. You can do SPY. I think you can do those short or long. I'm pretty sure. I think it's just a 3x ultra thing that they don't like in Canada. If not, you could open up a US account just for your hedgings. You could also offset your hedges with stock plays. So instead of shorting SQQ, you find something that should absolutely go higher if the market comes back. You know, like maybe a short on oil or something like that. You know, something that makes sense if the market gets better. That would go down. So in other words, the market's not likely to get better unless oil goes lower, in which case the USO short could offset your loss is an SQQQ, something like that. There's you got to just think around it. And I would be very happy to do that with you in chat. Oops, what happened? Damn it. Well, let's try it again. No chat messages yet. Oh, wow, that's really messed up. Did I just clear them? People, questions. Question thread. On the Conagra trade, you're talking about the $17 naked puts. Would you have maybe sized it 25 contracts if you chose the $15 strike? It's about the net assignment. So again, I went over my reason why I did it, because I want to take advantage of the move up. I would not really sell too many more because you're taking on a larger obligation. So you have to keep it proportional to how much you ultimately will be forced to buy. And Jorge says, I got later on the Conagra trade. Now the premium is less. Should I take it? Wait. I would just look. It's very very volatile. So maybe you just want to, put an order in, put it good to cancel, and see if it fills or not. If it doesn't fill after more than an hour, because you're not giving it much time, if it doesn't fill after a while, then maybe think about changing a strike. But don't just right away. There is no urgency. When we put up these trade ideas, they're trade ideas. You see a lot of times in the portfolio, they don't fill for days because we put in good to cancel orders and we wait patiently for them to come in. If you clearly see the stock is trending away from you, or the situation changes or something like that, then sure, make an adjustment. But ideally, your go-to position should be waiting. No one's forcing you to have this trade. It's not necessary to get it, and especially if you're paying a worse price. Also, and we could do a whole thing on this, take advantage of the momentum of the trade while it's happening. So in other words, if we're talking about Conagra. So if you look at Conagra and we look at a chart. So here's Conagra today. It was at 1530 and now it's at 1560, and now it's coming back a little bit. And so if the momentum right now is down, I should be selling the call, right? I want to sell some calls, not all of them, a few, until you get it covered. But I would say, oh, look, we hit resistance here. So I'm going to sell the calls now because this is as good as they're going to get. And I'm going to wait for, look what's happening now. I'm going to wait for this to happen. And I hopefully will fill in my short my short calls. I'm sorry, I'm selling the calls I'm going to sell. If I want to buy my long calls, I'm going to wait. If I want to sell the puts, I'm going to put the order in now. And as it comes back down, hopefully it fills. If not, whatever. But meanwhile, look, this is last week. This is Friday. Friday, it went up to here. Then it went down to here, which is basically as low as it was today. Then it went all the way back up to here, which is higher than today's high. Down a bit, all the way up to here, which is like the high for the week. Down a bit, up a bit, down a bit, up a bit, down a bit, and all the way down. And now all the way back up here, which is where it was last week. And now it's going down again. So no matter what reasonable price I put in at this point, it would have all filled by now. But only if I waited, because I could have sat there Friday and said, oh, I'm never going to get the price, I give up. And then it goes down. Oh my God, I got to do it right now. And then it goes up and go, oh, damn it, I should have waited. That's how stocks are. They go up and down. And if your time frame is only going to be 60 minutes, you're never going to get a fill that you like. You can't exempt yourself from paying attention to what's actually happening. And again, these are pivot points. We've had conversations about this. They're super useful. They will tell you what the range looks like very easily. This is what the expected range is. Yesterday, the range was here. It stayed in the middle. Here, the range was here. When it blew over the range up here. Then it went back down. Then it went here. Then it went back down. Then it came back here. This is around where you're going to, this is your best price. This is your worst price. You take the price of the stock option and the delta and the amount that it moves, and you can actually say, and this is why I sound so smart. That's what I do. I look at the range, I look at the price, and I say, here's the price we're likely to be able to fill. And so I go back to so where is it? Let's say the June. Let's say I'm trying to sell the June. We're at 1550. I'm trying to sell the June 16 calls, right? So I'm going to copy. Copy it. I'm going to go back to the chart, and now I'm going to put the chart of specifically that contract. And what's the range of the contract? The low is 65, the high is 90. And again, going back the same period for the week. So here's 80, here's 70, here's 88, here's 80, here's 75, here's 65. Now, in this case, we're trying to sell these. So I want to sell them for, I think 85 is reasonable. Given the past week's performance, I think selling it for 85 is a pretty good price. And again, also very important, since we're bullish and we think it's going up, all the more reason to pick a strike that's in the higher end of the range that it's been in. Now, if I were buying them, I would want to buy them at 65. I would say I'm going to frickin' wait and buy them at 65. And if I can't, if it never fills after a while, I'll be like, okay, I guess I can't buy these for 65. What about the next one? But if I can't buy these for 65, that means the ones I'm selling should be certainly available at a higher, I should be getting my price. We're buying 4 or 5 legs going in different directions. Okay, you can't, it's not possible that you can't fill any of them. Some of them have to go your way and give you a good price. And that also is as far as filling is what I do. If I'm selling and I want, let's say these are, I'm trying to get 80 cents. Let's say I'm trying to get 75 cents for these, right? As a sale, I will put in for 80 or 85. I'll look at this chart and I'll say, oh, I think I can get 85. So I'll put in for 85 and see if they fill. If I'm buying them, I'm going to put in for 65 and see if they fill. That's a 20-cent spread, but you know what? It's a pretty good chance it's going to happen. If I just a week ago, 65, now back to 65. A week ago, 80, 85. Here's 85. Did it hit 85 again? Sure, it did. It hit 60, then it hit 85, then it hit $1. Then it went back to 70, then it hit 60 again. Now it's back at, well, it's not back at anything. Now it's at 70. All you're doing is paying attention. If this, and it's weird because if this was a map of a river and the river went like this and like that, right? And that's the winding of the river. And sometimes the water goes faster and it goes more over one side of the bank or the other, right? Sometimes the water goes slower and it stays more in the middle of the bank. Well, it doesn't take a big leap of faith on your part to say, okay, based on the weather and based on what I see and based on the runoff, I can tell you that you can probably put your foot here and not get wet. And you can put your foot there and not get wet because those are the likely ranges of the bank. Or when you're at the ocean, right? There's tides, but at any given time, you know where to put your sandcastle. You know this because you see it. You sit and you observe it and you say, oh, there's where I'm going to put my sandcastle because the tide comes close but not close enough, and it looks cooler when it's close. You want to impress your kids, so it comes in. And also, the tide is coming in. Therefore, if you build your castle there now, in an hour or so, it's going to get washed away. And that's fun too after you build them. It's the same thing. It's the reason so many people gravitate towards TA is because you see these patterns and the patterns confirm themselves and you feel like you're very smart because you saw the pattern. It's just human nature, but it's not invalid. This is a cycle that we're going through for buying and selling. Now, did something different happen? Sure. They announced earnings, they made guidance. That may have changed the pattern, but so far not for the better. And for Nike also, Nike for the much worse. So now if it was Nike's chart, well, where are we? Let's do 45. 45, and change this to Nike. So here's Nike's chart, and I wanted to get 350 for this call, which is the 45 calls now in June, right? But now something changed. They announced their earnings. The stock dropped, and now it's $3. So if I still sit here and say I demand 350 for these calls, I'm not going to get it. I have to adjust my expectations now. Something happened that shifted the stock lower, and not in a way that I think it's going to bounce back that quickly. So therefore, I say, okay, I'm going to have to accept the fact that I'm only going to get 350 now, or instead I sell the 4250 calls. I think there are 4250 calls. Yeah, there are. So now I can sell the 4250 calls for 450. So now I'm thinking, oh, let me see. I could either sell the 45 calls for 350. I'm sorry, for 3. I can either sell for $45 calls for 3, or I can sell the 4250 calls for 450. I get an extra $1.50 for giving up $2.50 in strike. That probably makes sense. I'd rather have the money and the protection. So what I do, I just looked at the difference, and that's when I changed my strike, because the situation has changed. Because it's not a random variable. It's not just sort of shifting along that area anymore. It has been permanently repriced. That's what's going to cause me to start looking at a different strike. I'm not satisfied taking only $3. How do I fix that? Well, I take a lower strike and take 250. Why would I take a lower strike? Because I can always roll it out of trouble later. I don't think Nike is coming back anytime soon. It's going to drift along down that range. So therefore, in 3 months, I will roll it to the September 45s or the September 47.50s. But the more important thing is I'm getting my $4 in my pocket now. That's why I'm willing to change my strike. I don't have the confidence in the stock to make up for it. Canadian shorting options is available in non-registered accounts only. Oh, get a non-registered account then. Would Nike fit in a smaller portfolio? No, it's too volatile. It's a dangerous stock, and it's not worth the risk. The smaller your portfolio is, the less you want to lose money. You've got to have the patience to make the money slowly, like we did in the $700 portfolio. We only averaging 60% a year only, but we're averaging 60% a year, and we've made $28,000 in deposits, yet the portfolio is over $100,000 now. We're up 300% in 4 years, but you can't be up 300% in 1 year. When we started, we were only trying to get up 10%, and it just we happened to hit a good rally, and we took a risk and it worked, and we took another risk and it worked. And every time we take a risk and it worked, we can afford to maybe lose the next time. We've had very, very, very good success, but every time we're going for nice conservative numbers. You cannot take highly leveraged plays, you cannot play stocks that are coin flips in a small portfolio because you can't recover. You don't have time. You're losing so much position when you lose money in a small portfolio that you end up you could take a whole year off the progress. That's never worth it. This system is so much worse for questions. I can't believe how bad this is. David says, I missed the first part of the last question, but Interactive Broker will let you sell SQQ call spreads for Canadian account. Oh, see? Switch brokerage. That's a great suggestion. Thanks, David. I honestly, it's such a mess. I'm sorry if I miss people's questions because this is insane. Let's see. Stephen Wolf, good name. With the Magnificent Seven not reflecting the S&P 500 and the ETFs, is there an ETF that is constructed? Is there an ETF where every company has the same value? Well, yeah, that would be an equal. There's an equal weight ETF for the S&P, but that has its own problems because it's like the Dow. The Dow is an equal weight. Well, no, the Dow's a price weighted ETF. It's just a different. You just trade one set of problems for another. I mean, there is the actual Magnificent Seven, ETF. But there's no perfect way to do anything. But the reality is, the Magnificent Seven drives the S&P and the Nasdaq and the Dow basically. So the Magnificent Seven drives the S&P and the Nasdaq. So if they go down, the Nasdaq's going down. It's not going to stay up. Apple at one point was 20% of the Nasdaq before they rebalanced it, and we called it the Apple DAC at the time. It was ridiculous. There's no point. The Nasdaq had no point in being an independent ETF because Apple completely controlled it. If Apple went down, it went down. If Apple went up, it went up in basically the same amount. So with the Magnificent Seven, you can just trade the MAGS ETF, which is tracking directly the Magnificent Seven. But we like the SQQs because it's a leverage. The 3 times leverage gives us a huge amount of premium when we sell options against it, which helps pay for the insurance. That's why we like it, not because it's a perfect ETF. We like it because it's an insurance policy that pays us our money back. That's what we like about it. And Jorge says for 140,000 portfolio, I should just stick to the 700 a month. Those kind of positions, yeah, you're in between. You're getting towards the point to graduate, but you know what? Get to 250,000 first, and then start messing around. Get a substantial portfolio before you start doing much. And again, the question is, do you have portfolio margin or do you have a non-margin account? If you have a non-margin account, absolutely stick to the 700 a month type trades. Don't start playing like you have margin if you don't. And if you have margin in your $700 a month portfolio, if you have margin in the account, you can afford to do some trades that have puts like the ConAgra trade, but you've got to be really sure and absolutely be happy to commit to owning the stock long term, et cetera, et cetera. It should be used very, very, very sparingly. But it goes back to the same thing. My attitude on ConAgra is I'm like, well, if you want to sign me 1,000 shares of ConAgra for net $13, go right ahead. I'm happy to spend that $13,000. And if I do own $13,000 worth of ConAgra stock in an ordinary margin account, I'm only going to use $7,500 worth of margin, $6,500 worth of margin. That's my math. So my allocation blocks in let's say if you have $140,000 and you have portfolio margin account, basically you can easily have $250,000 in margin to play with. So your allocation blocks, if you have 20, should be $10,000. That means obviously if you commit to owning $15,000 worth of stock, it's only one allocation block. It's not a big deal. And functionally, if you do own $15,000 worth of Conagra stock, 1,000 shares at $15, you will have $7,500 in margin assigned to that. That would be one allocation block in your portfolio, not even. And that means you can afford to play it. But that doesn't mean you should play it. It just means you can afford it. Now the question is Conagra a stock you want to stick with for the next 10 years if there's a disaster? If it drops 40%, is this a stock you want to nurse back to health? There's no, yeah, sure, do that kind of answer. You've got to be thinking about, is this how my portfolio wants to be constructed? Is this how I want to make my money for the next 10 years? And if not, don't sell puts or put very tight stops on what you sell. Brad says, how much margin would you estimate is needed if your Nike in your Nike trade with your usage of the portfolio margin? Again, assume you're going to get assigned all the puts, which I think was I don't know, 20 whatever. So it's 20 puts, and Nike is $45. So that's $90,000. And if I own $90,000 worth of Nike stock, my net margin for it is going to be about $45,000. Now, in reality, yeah, 2 puts is fine. No. Oh, shit. Cancel. So in reality, on Nike, if I get assigned 1,000 shares of Nike at $45, okay, for whatever reason, what am I going to do? I'm sitting here with the stock. I'm immediately going to sell like these $45 puts for $9.75, let's say $10. So I'm going to sell these calls. I'm sorry, not calls. I'm going to sell the $45 calls for $10. That's going to drop my net from $45 to $35 right away. And then I'm going to say, do I want to commit to doubling down again? And if I decide I'll commit to doubling down again, now I'm going to get $9 off doing that. So this drops it to 35, and this drops my net to 35 minus 9 is 27. So the minute I get assigned at 45, I sell the $45 puts and calls in 2028, and I drop my net to 27, which means now what 2 things are going to happen? I'll either get called away at 45 with a double, so money well spent, right? I'll either get called away at 45 with a double and the puts expire worthless, or below 45, I'll get assigned, but the net on my first 1,000 is 27, right? So it's going to be 27,000 plus 45,000 for the new batch is 36. So again, the question is not to me, I'm always the next step ahead. So the question to me is not, do you want to own 1,000 shares of Nike for 45? It's, do you want to own 2,000 shares of Nike for 36? And what's going to happen if I get assigned at 36? I'm going to sell more freaking calls for $10 and drop it to 26. And then I'll sell more puts and drop it to 30 to 26 from to 17 or 16 or whatever the hell it is, or 19. So with Nike at 45, I'm really saying, do I want to own 4,000 shares at 25? That's $100,000. Yeah, I'll take that. So when I say I'll double down on it, it's not even doubling down at 35. It's doubling down and then doubling down again to have 4,000 shares at 25. And if I don't want to have 4,000 shares of Nike at 25, I have no business at all selling 10 puts for 45. No business at all. If you are not absolutely thrilled with the idea of owning 4,000 shares of Nike at 25, $100,000, then what the hell are you doing selling 10 puts for 45 at 45 strike? Lying to yourself. You've got to take it through to the conclusion and say, I would be willing to do that. I would be happy to do that. I will sell my IBM to pay for my Nike because IBM is not going to give me a double, but Nike will from 25, or that's what I believe right now. And it's not even, and that's not even the real price, because in reality, what's going to happen is I'm going to roll them. So in other words, if I was being assigned right now, if I sold the $60 puts, what is going on here? This is so annoying. I hate this new system. If I had sold the April 60s and I was being assigned at $15, right? So let's say I sold 10 April 60s and I was going to be forced to buy Nike for $60. And I didn't sell them for 15, I sold them for 10. Okay? So I'm down $5. Well, I don't have to buy $60,000 worth of Nike. I can pay $5,000 and get out of the obligation. And I say 5, I mean, I'm giving the 10,000 back that I collected, and I'm paying 5 more than I lost, and I'm taking a $5,000 loss. So that's option number 1. Option number 2, I look at 2028, and I see the 5250 puts are $13, and the $50 puts are $11.50, and the 4750s are 10. And that means I can pay $5 instead of giving the 10,000 back that I collected. I just put $5,000 back. So I still keep 5 that I collected up before, and I roll to these puts at 47.50. 47.50 is basically the current price. So what does that mean? That means the next year I should be able to drop Nike another $10 or so for the other $5 if I have to give it back. So my net obligation is really $37.50. I'll roll it again and be down to $37.50 from $60 without spending a penny, just giving back the money I collected. So even when I'm telling you this, how cool it sounds, I can lower the price and lower the price. I can also roll and lower it even more. So unless I think Nike is going bankrupt between now and 2030, unless I think they're going to go out of business, I don't see why I'm not worried about selling the puts. It's not an issue, but that's because I can afford to own it in the portfolio. And when I say I can afford it, we have a lot of put obligations, although we just bought them all back. We just canceled our put obligations for the most part in the long-term portfolio. But in a normal market, I have a bunch of put obligations. I will then decide which ones to take some cash and get rid of, and which ones to roll along to a lower strike, and so on and so forth. Those are the adjustments we can make. Always in motion. There's always choices that you can make. There's always things that you can do to make adjustments. Oh shit, it's 3 o'clock. That went way faster than I thought. Wow. And we had other stuff to cover that was interesting. You guys with the questions. All right. So, we had a really, really good conversation about the 5% rule, and Warren gave a whole big thing about how it works exactly with examples and explaining it. And I hope that works for everybody, but I definitely check that out. And really read the roundtable notes. I mean, especially the supplemental notes that they put in are freaking brilliant. I gotta tell you. These are the initial comments from the roundtable. And then Clown Daddy asks this question. I'm confused by timing. La da da. Look at oh wow, it's like a book. Then they had a special April Fool's section, which I think after that we did the thing. Then I talked. Oh, I don't know. Anyways, but just as an example, though, I mean, look at Look at these comments. While retail investors are distracted by consumer brands, I'm filtering for the actual mechanisms in the AI supercycle. The fools who think artificial intelligence is just software and silicon game, AI. Oh, this was a great observation. Yeah. AI intensity is physical. It requires blue collar infrastructure. Look at Target Hospitality. See, this is so off the radar that it would not in a million years occur to me. Yet, how brilliant is this concept that these AI companies, when someone is spending $100 billion, it goes to a lot of people. And these little tiny companies like TH that do things that you don't realize, they have to cater to the people, the thousands of workers that are hired to construct a data center need food. And so this little teeny company that feeds the people who are building the data centers gets called up by Silicon Valley, who have no concept of money and will spend whatever it takes and say, yeah, get me 100 trucks. They're like, we don't have 100 trucks. They're like, go buy 50. I'll give you a long-term contract. And all of a sudden business for these little teeny companies is just booming because they have to service these projects. It's like when a city gets a bridge contract or something like that. It's like a big boom of all these little industries suddenly sprouts up. That's what these data centers are like. They're multi-billion-dollar projects that are getting built in places, and it's a short-term boost, but there are certain little companies that benefit. So always be on the lookout for that kind of thing. Like what local companies are getting put to work, what goes on in your area, who is a small public company that might be dealing with this sort of thing. Because if we look at TH, they only have $329 million in sales. But let's say that they're getting 4,000 people, $15 lunches, 200 days a year. That's 12 million bucks. That's going to move the needle significantly for this company. So you keep your eye out for plays like this, and it's really amazing. When you let these AGIs do their research, they're looking at stuff that just you would never notice. It would fall through the cracks and so on and so forth. But they see it. They see that they're like, oh, there's a contract given to this guy. I would not pay attention to that, frankly. I'd be like, I don't know who TH is. But when you think about it and back out the logic, it makes perfect sense. It's like we should be looking for companies like this. I'd prefer one that makes money. This one doesn't make much money. But you look for small companies and they show some huge growth. Look at what they're projecting. They're projecting going from 320 to 420 next year, flipping around a profit. The company's a $1 billion company. I wouldn't pay $1 billion for this, but the growth is there. They're looking like they're doing something. But that's cool. Those observations are really cool. And there's a lot of gems like that. Like every day we're getting cool ideas like that. And also every day. So now 200 times a year, Warren is giving us a trade first thing in the morning. So, I average 100. My average is about 100 ideas. Twice a week I'll have a trade idea. That's my average. Warren's putting up one a day. Now, he doesn't care if he said it already. He puts up whatever's happening that has a catalyst that makes sense for an investment right this minute. That's his criteria. If I disagree, it wouldn't be there. I would cross it off. But he's very good and he makes excellent picks. So we've got that and the trends and what they're watching and the analysis. It's freaking phenomenal. So certainly take advantage of that in the chat room. I mean, this is gold. This is better than any other reports I've seen on the market anywhere. All right, so thanks everybody for coming. I appreciate it. I don't know how to close this thing down, but we'll see if we can figure it out. And we'll do it again next week, and I probably still won't know how to use this thing. Okay, great. Thanks. Have a good day, everybody. I guess I'm going to hit this button that says leave the session, or is that going to leave it running? I don't know. Oh, maybe something up here. Toggle report. No, none of those. I have no idea what I'm doing. All right. Bye, guys.